Welcome to the VestCapital podcast, the go-to platform for accredited investors, real estate developers, and entrepreneurs seeking to build wealth by investing in private real estate.
Are you not entertained? Are you not entertained?
Every time, every night is a loose one. And every flight, you know that I put the crew on. You say that I drop.
Welcome back to the VestCapital podcast. My name is Tanner Wideriksen, your host. As always, it is incredible to be here together with you today. In this opportunity that we have together, we are going to be diving deeper into the capital stack. This month's theme is predicated on the component of private equity, more specifically, the capital stack. So in the first session that we had here, we went a bit on a broad level, describing what the different layers of financing components consist of. So a recap, we've got 1, senior debt, we've got 2, mezzanine financing, we have preferred equity, and then common equity. So this particular pod, we want to go more granular in relation to why deploy senior debt, mezzanine financing, preferred equity, common equity, and who should consider allocating those types of funding sources. What is their risk profile? What is their capital availability? What is their tolerance for the duration of the financing as well? Because there's many forms of financing, both short and long term. So we're going to focus more on shorter term investing, and I'll define shorter term investing as 36 months and under would be a short term investment, particularly with VestCapital. We do like 3 years because that's typically the natural life cycle of a real estate development. From dirt to keys, it takes all of 36 months to get a raw land fully entitled and in a position where you can pull a permit, build it out, stabilize it, refinance it, and sell it. So let's start off with number 1, which is senior debt. Traditionally, senior debt is reserved for financial institutions, credit unions, banks, insurance providers as well that have large sums of capital. There are certain affluent individuals and family offices that do have a significant AUM, and they do decide to take a conservative position and lend because senior debt is the lowest on the capital stack. And they do take on the lowest amount of risk because they are secured by a deed of trust and first lien position. They have the first rights to exit the property as it is refinanced and sold, or worst case scenario, if the asset does not perform, they have the first right to then take the property back. So if you're looking for senior debt and you don't want to take a tremendous amount of risk and you do have the volume to then allocate, typically the deals that we're doing, 7 figures is approximately the amount that you need to start with when it comes to a loan of our project size. You are first to get paid and you have first lien rights on that property, but you are also accruing a smaller interest rate. It's proportionate with the risk that you are taking, right? You need to have an alignment between the risk that you're taking and the amount of profit that you are going to be capitalizing on. So if you're looking to take some risk off the table, you don't need to take any larger than necessary hits in terms of baseball, you don't need to do any home runs, then senior debt position is going to be a strong investment vehicle for you to consider. Now, if you want to take on a bit more risk but still have security in the asset in the form of a mezzanine position, you would have a second lien position on that asset, and you would be second on the capital stack, just above the senior debt holders. And the risk is a little bit higher because you're behind the senior debt holder, and you would also have a bit of a larger yield on your loan or your investment. Third, you then have preferred equity. All of VestCapital All of our accredited investors typically are in a preferred equity position in our investment funds, and they are in first priority position ahead of myself, and they then get paid after the senior debt is relieved and the mezzanine, if there is any mezzanine financing on these assets. And then they have a security interest, typically in the form of units in our investment funds. And then our funds then hold the ownership on the asset. So that is the security that the preferred equity members hold. Then you have common equity. Common equity is typically conveyed on perhaps the sponsor, and they get paid very, very, very last. So if you imagine a 4-story building and you've got different levels to exit this building, the first floor would be senior debt. They're first to get out the door. The second floor, they hit that lobby button on the elevator. They go down one floor, they're out. Then you got the third floor. They got 3 floors to go down in preferred equity position. And then the sponsor, the developer, is very, very last, which I really like this because it really provides an alignment of interest between the developer and investor, because we are putting all of our eggs in the basket of performance over taking the profits ahead of anybody else. So our investors like that because they know that we have to ensure that the project is successful in order for us to get paid out. So that's the approach that we take by structuring our deals in that order. And this has historically been proven as a very compelling model that is sustainable for both the short term and the long term for residual and recurring investments within our investment funds. Appreciate you guys for taking the ride with me, and we will see you on the next one.
That's what I'm constantly summoning. I love the climb, I don't care where the summit is. Funny when people be saying I peak. Retired, my parents, they live at the beach. Models and freaks is my track record. I made my homies my staff members. Got myself lit to give y'all the light. Using my mind to attract.